Thank you, Mr. Chairman, for being here. I'm concerned about some of the negatives, which could clearly grow over time, about the zero interest rate policy. What would you consider the list of present or potential negatives, and how do you go about sort of monitoring those to always determine whether this continues to make sense in your mind?
Well, a number of issues have been raised. One that's often raised is the return to savers. With low interest rates, does not penalize savers. We're aware of that. We take that into account in our discussions. But as I mentioned yesterday, something of total household wealth, something only less than 10%, according to the Survey of Consumer Finances, is in fixed income instruments like CDs or bonds and so on. Most household wealth is in other forms: equity, small business ownership, real estate, etc. And our efforts to strengthen the economy will increase the returns and value of those assets. And so on net, our activities are raising household wealth overall, even if they are reducing the interest rates you can receive on fixed income assets. And of course, keeping inflation low also helps in that respect. Second issue that we hear a lot about is pension and insurance. That low interest rates increase the contributions that those companies have to make. Again, we've had many conversations with those folks about these issues. I would say that it's a serious issue, one that we look at. There are, again, countervailing factors. If you look, for example, at compensation to workers, which includes pension contributions, it remains quite low, like 2% a year, growing. So these pension contributions are significant but not massive. And on the other side of the balance sheet, of course, pension funds and insurance companies have to invest in the economy. And once again, a stronger economy produces higher returns in equity markets, real estate markets, and the like. The third issue, which is very tricky, has to do with possibly creating financial bubbles of various kinds. People have different views about that. Our view is basically that the first line of defense against bubbles should be what's called macroprudential supervision. That should be, supervisory approaches, looking at what's happening in the system and making sure that financial institutions are as strong as possible through capital, for example. And we have greatly upgraded our ability to monitor the financial system since the crisis. And we are, both trying to identify potential problems, but also making sure the institutions are sufficiently strong that if there is a problem, that they'll be able to withstand it. If those things don't seem to be working, then we're prepared, I think, to take that into account in monetary policy. But those are some issues, and we are aware of them.
One thing that might have been first on my list is commodity prices. Mm-hmm. A weak dollar pushing investment toward commodities, pushing up commodity prices. And of course now, the most obvious example of that is gasoline prices. Briefly, how would you analyze that, and when does that start becoming such a negative that you rethink this?
So I think the two ways in which low interest rate policies realistically would affect commodity prices, first would be through weakening the dollar. But the dollar has been pretty stable. It really has not moved much since, for example, November 2010 when we introduced QE2. The second is by creating growth, both here and perhaps to some extent internationally. Higher growth increases demand for commodities, that raises prices. That's kind of inevitable. If you want to have a growing economy, that's going to put more pressure on oil prices and so on. So those two things, I think, have not been a big problem. I think particularly if you look at commodities, the one commodity that has been particularly troublesome has been oil. And currently, it's quite obvious that there are a number of factors affecting the supply of oil, including concerns about Iran and supply issues in Africa and so on that are contributing to that increase.
The most of the quantitative easing announcements have more or less coincided with increases in oil prices. Are you saying that's largely a coincidence or not?
No, it's not entirely a coincidence. First of all, if you look over longer periods, it's not quite as close a correlation as you might think. But I think part of the reason, again, that there is a coincidence is because to the extent that the extent that monetary policy is structured in a way to increase growth expectations, that feeds into commodity prices through the demand channel. So that is one link that I do agree exists.
And if I can just wrap up, Mr. Chairman, at what point, particularly with regard to oil, at what point would that factor driving up prices be a sufficient negative in terms of economic growth that you would pause in terms of this 2014 zero interest rate policy?
Well, we'll always keep looking at it, but our analysis suggests that the other benefits of low interest rates through a whole range of asset prices, through increased consumption and investment spending and so on, outweighs reasonable estimates of the effects of that on commodity prices in terms of growth. And again, I think the reason we've seen these sharp movements has more to do with international situation than with U.S. monetary policy. But obviously it is a negative and something we want to keep monitoring.
Thank you, Mr. Chairman.